Perfect. It looks like we have almost everybody in. Well, good morning. My name is Patrick Marcinko. I'm a financial advisor here at Bogart Wealth. I'm also a certified financial planner. And I want to welcome you to our webinar this morning about interest rates. So for those of you who might be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. And so a little background on the firm. We have approximately $2.9 billion of assets under advisement, $2.7 billion of assets under management, and we work with approximately 1,300 households. Now, we are a registered investment advisor, which means we are an independent fiduciary advisor working in your best interest. We custody our assets at Charles Schwab for your protection, and we are a fee-only wealth management firm. For Bogart, we have financial advisors located in McLean, Virginia, as well as Houston, Texas, and we work with clients in numerous states all across the country. We have a full operations team and financial planning team in our Virginia and Texas offices. Here's a little bit more of that team. We also manage our investments in-house and work with the local CPA in Texas to help our clients with their tax preparation needs. Our headquarters are located in McLean, Virginia. In addition, we have two offices, one in Houston, one in Gessner, and then one in the Woodlands. And for those of you who work with us, you know that financial planning is really at the heart of what we do. And so for most people, when they think about planning for retirement, it's just about the investment management piece of it. But everyone's situation is different. And it's important for us to focus on your goals and manage the issues that are important to you. Now, if you're new to Bogart and you have not gone through our financial planning process, I encourage you to reach out to an advisor or myself, and we can talk specifically about what you and your family are working towards. So with that, let's get started with the topic for today. So we produce a number of educational webinars throughout the year. Today, we're going to be talking about interest rates, but I invite you to join future webinars as well. Our website, bogartwealth.com, will have some recorded versions of the previous webinars. As you can see, we cover a wide spectrum of topics: retirement planning, Social Security, NUA, long-term care planning, mega backdoor. So if you have any questions on those topics or want to learn more, feel free to let us know. So the big question for today is, how do the discount rates affect your lump sum? And when we're speaking about interest rates today, I want to note that this is really geared towards the ExxonMobil pension program. Now, this could relate to someone who does not work at ExxonMobil, depending on what their pension options are and how their company manages their pension. But today's webinar is mainly going to give us an idea of, okay, what interest rates are doing across the board and how they're going to impact the various parts of the ExxonMobil pension program. So specifically, we're going to be talking about there's various parts of the program. We're going to be talking about the qualified pension. Some of you on the call today may have the non-qualified components. Sometimes they're referred to as the APP or the SPP. And this call is still relevant, but we're going to be mainly focused on the qualified pension program today. As it relates to interest rates, though, all parts, the qualified, APP, SPP, all of which are affected by interest rates. So one of the questions that comes up all the time is which discount rate applies to you. And for almost everybody on here, all you need to remember is the general rule, in that the rate that's in effect on your benefit commencement date will be the one that applies to you. Benefit commencement date is, I'll sometimes call that the BCD. So the BCD is always the first day of the month. It doesn't matter if the first day of the month is a holiday. So just to use an example, to get the second quarter discount rate, the absolute latest your BCD can be that year would be June 1st. So by July 1st, you would be already in the third quarter. Now, there's an exception to that, and I don't know if there are any grandfathered folks in the room today. We'll get back to the definition of grandfathered in a minute, but grandfathered in this situation really comes from the Pension Protection Act of 2006. And so for the grandfathered individuals, they have the option that if they choose the first available BCD, then they can actually choose the interest rate on their first day of retirement, or they can choose the interest rate on their BCD. So essentially what this means is that an individual would have to make their last day of employment either June 29th, and this would result in the first day of retirement being June 30th. If they did that, they'd be able to choose between the second quarter and third quarter rates. That being said, that applies to very, very few people. We have a lot of confusion around this. So if you have any questions, I'm happy to discuss outside of today's call. So I've talked a little bit about the Pension Protection Act of 2006. This went effect in 2007. It made some big changes to pensions as we know them today. And the most important part of that is that it placed limits on companies who could provide a lump sum pension. So for example, for a pension that's going to offer a lump sum option, they need to be 80% funded. If the funding level drops, then their lump sum options can change. This has never happened to Exxon, so we haven't focused on it as much. But we changed some of the funding criteria there with the Pension Protection Act. In addition, the Pension Protection Act defined what the discount rates are that are used in the calculation. Notably, they made a change. They went from treasury rates to corporate rates. We'll talk about the impact of that in a little bit. Another update that they did with the act was it required companies to update their actuarial tables every 10 years. I believe the last update was done in 2018. So they have up until 2028. They certainly can do it sooner to refresh the actuarial table. So there's some other items that changed, but for most of them, they don't affect the lump sum option we're going to talk about this afternoon. So, all right, it's becoming more and more uncommon that folks are still covered under the grandfathered section. But just in case there's anybody on the call today that has the grandfathered rates, let's kind of discuss that, what that may mean, and how your plan is slightly different. So this really came out of the Pension Protection Act, and ExxonMobil adjusted their plan accordingly. And what that meant is an individual has to be age 55 and had 15 years of service to be in this category. What effectively that meant is that you had to be born before 1958 and hired before 1998 with no breaks in service. So if you're wondering, is that me? That person would have to be about 67 years old and have worked with the firm for about 27 years. So naturally, it's probably a pretty limited number of folks that would still apply to. But if you are in the grandfathered category, all this means is that you just use the 30-year Treasury bond rate in the mortality tables from 2000 rather than the updated ones. So a few more slides for our grandfathered pension folks. And what this chart is showing is the long-term trend of the 30-year Treasury. And as you can see, we've really seen interest rates decline over a period of decades, but right now we're coming out of historic lows and interest rates have been climbing recently. And so despite, levels not being quite what they were in the 80s and 90s, because of the recent spike in inflation, we have seen rates start to climb. So again, this chart really only is relevant for those in the grandfathered category. For those grandfathered individuals, one of the things to note is that when we're calculating the pension, we'll get to this in a second, every day counts for that group. So essentially at a simplified version, you take 95% of the 30-year Treasury rates for the period you're evaluating, round that to the nearest 0.25%. It's actually a pretty simple calculation, but again, applies to very few people right now. So one more slide for our grandfathered individuals. And the biggest distinction is that for those grandfathered folks, every day counts when determining the interest rate for their pension calculation. So you can see on the slide here kind of how we calculate this from the raw data that we have. Essentially, we take the average by days, not by months, take 95% of that, round that to the nearest quarter percent. So for any folks that are in the grandfathered section, if you have any questions, please feel free to let us know. Let's talk now about the non-grandfathered rates and what that means. So for those of you who are under 50 and had less than 10 years of service on December 31st, 2007, these are the plan rules that are going to apply to you. Most of the folks on today's call, you're probably going to be under this category. So I mentioned this earlier, but the new rates that are tracked use the corporate bond rates instead of the government bond rates. This was kind of a tougher change for pension participants because corporate bond rates are typically higher than government bonds. And as we'll cover in a few minutes, higher rates are not necessarily better when it comes to your pension. And if you want to see exactly what the corporate bond yields are right now, the IRS actually publishes them on their website. And so we'll get to this in a minute, but one of the key distinctions where with the grandfathered folks, you were using one 30-year treasury, the new non-grandfathered folks are actually using 3 segments to calculate their interest rate. It's a very important difference with the new rules. We'll get to that in a second. And one other key update that companies did is they updated their mortality tables. We'll talk about this in a little bit, but as I mentioned, mortality tables need to be updated every 10 years. This was actually a good thing because the longer life that are in the updated mortality tables actually helps your pension calculation because there's going to be more, call it annuity payments factored in, which will in turn increase the lump sum. So when we think about segment rates, here's what they've looked like since they've been published. Now, I mentioned before, with the grandfathered, you had one rate. Now you have 3 different rates to track. And so when we look at this, segment 1 rates are shorter term rates, call it 6 months to about 5 years. Segment 2 here is from 5.5 to 20 years. Segment 3 rates are everything beyond that. So call it 20.5 all the way out to 60 years. And as you can see, with the Federal Reserve changing rates, shorter term rates can be a little bit more volatile, but each segment of rates uniquely affects the pension calculation. Recently, segment rates, as you can see here in the chart, have come pretty far off their historic lows following the pandemic, and we'll talk about that more in a few slides here. So let's drill down on the items kind of coming from the last slide. And one of the biggest things to know is that only the last 2 months in a quarter are used in the pension calculation for interest rates. So Bogart, we track the daily rates for each segment. We compare them with the published data for our projections. But just keep in mind that the rates in the first month of a quarter do not actually count, but they give us an indication of where rates are headed. So you can see on the left slide here, for the actual rates that we have, these numbers have been published by the IRS. Now, if it says projected, that's the Bogart Wealth model. And on the right side, you can really see that the illustration begins with the last known month, and then we have projections as the month is in progress. So for November, we have what the IRS published as the segment rates and what FRED, the Federal Reserve of Economic database, published for corporate bond rates. And so we track these every month. And what we essentially do is we look at the average for how these have changed from the last known month to the current month. And from there, we make 3 different projections. And then we average those 3 to get our own projection. Talk about that in a second. So the last slide had a lot of different moving parts. Let's talk about that in a different manner. And so before I get to that, let me pause real quick. It's incredibly important to note that the annuity option is not affected by changes in interest rates. So when you think about your annuity payment, the change in interest rates on this slide have no impact on the value of what your annuity would be. For the non-grandfathered folks, you know that there's 3 different groups of interest rates that apply to you. But it's going to be hard to look at 3 different rates when you're thinking about your pension. So sometimes you could have different rates moving in different directions. And so it's hard to develop really a grasp of exactly how much the rate changes amongst the 3 segments change the bottom line. Well, we actually help give an estimate for what a single rate equivalent would be, so you can more easily measure the quarter-to-quarter change in rate. So in this example, you can see if you're comparing Q1 25 to Q2 25, just by looking at the 3 segments, you can see that there's likely going to be a slight increase, but it's hard to determine exactly how much that increase is going to be. But when you look at, in the far right hand of this slide, the 55 single rate equivalent, you can see that Q1 rates were just under 5%. The Q2 rates are actually going to be a little more than 0.25% above that. And so that's how we're kind of standardizing rate movements. And in the last few slides, the charts detailed the short-term moves in the single rate equivalents for the non-grandfathered folks. Well, we wanted to share a historical look and point out that corporate rates, similar to the 30-year Treasury for the grandfathered folks, they also are well below the highs that we saw in the 80s and 90s. But during the pandemic, when rates dropped to the lowest level, really in decades, rates have begun to move up, as we've experienced some inflation. So if you have any questions about the projections themselves, where we think that rates may be going the next few quarters, let your Bogart advisor know. We're always happy to help discuss the potential impact on your financial plan. So doing kind of a real life example. So when we've discussed interest rates, what we're discussing is kind of the interest rates and how that affects mainly the ExxonMobil pension plan. Now, let's think about what is the impact on the lump sum. And one of the things to think about is that when you retire, you do not have to elect the pension. This is actually something that I'd recommend working with your Bogart advisor on and determine whether it makes sense to delay the pension or not. And so in the next couple of slides, we're going to do a deep dive into the lump sum calculations themselves, and just, again, noting that the interest rates that we're discussing here, while they do change the lump sum, they do not change the annuity value. So in this example, we want to discuss a few different factors that were mainly impacting the calculation. Number 1 is the impact of age. Number 2 is life expectancy. And number 3 is ultimately the interest rates, which is the main portion of today's discussion. So in this example, we're looking at someone at 60, they're retiring, their annuity values call it about $70,000 a year. When we look at these factors together, that equates to about $1 million lump sum. You can see the $1 million in the top right of the table. Now, what are the factors that are affecting this? Well, number 1, life expectancy. In this example, life expectancy is 84 using the mortality tables. And so you can see that we have to model payments all the way out through age 83. During this time, regardless of what rates are doing, the annuity is still $71,000. But remember, this is where I was talking about earlier. Different rates impact this calculation differently. Segment 1 applies only to the first 5 years of payment. Segment 2 applies to payments in years 6 through 20. Segment 3 is all the remaining years. So in this example, we're using segment 1 rates of 4.34, segment 2 rates of 4.86, segment 3 rates of 5.33. All these factors combined, life expectancy, the annuity estimate, the segment rates would project the retirees' lump sum to be $1 million even. Now, looking at an example where someone, pretty similar fact pattern, but they retire at 55. And in this example, you can see the segment rates don't change, but what happens is the segments are a little different. So again, segment 1 is the first 5 years. Segment 2 is years 6 through 20. Segment 3 is everything after. The same segment rates as last time, but what changed is the annuity is actually less now. It's about 54,000. Why is it less? It's not less because of the interest rates. It's less because there's actually a reduction in the annuity payout if the benefit is taken early. So there is a haircut that applies to each year the benefit is taken prior to age 60. So you can see that we are assuming the annuity is now, if rough math, about 75% of what it was in the prior example. So another key factor to factor in here is life expectancy is actually 1 year shorter for someone taking the pension at 55. As such, there's actually more annuity payments though, because the benefit's actually happening earlier. So while I said the segment rates are unchanged, about 4.3, 4.8, 5.3, the years in which those segment rates are being applied has now changed. So you can see that from age 55 to 59, you're using segment 1. So now a person that is 55 will actually have more years on the back end of segment 3. So for someone who's retiring at 55, you're going to be more sensitive to changes in the segment 3 rate. So the segment rates and how they apply is very important to what the calculation turns into. So looking at this, kind of thinking about it a different way, here's how we calculate the single rate equivalent. Essentially what it is, it's the IRR, the internal rate of return, that's needed to get the lump sum value with the 3 segment rates. I'd say that this is probably a little bit in the weeds, but if there's any questions on the calculations themselves, we're always happy to go through. Please feel free to let us know. So one of the questions we work with a lot of folks with, and that relates to, okay, how do changes in interest rates ultimately affect my lump sum? In the prior examples, we kind of kept interest rates the same, but we changed the retirement date. In this example, looking at someone who is 60 years old, they're retiring with $1 million lump sum, the single rate was 4.9, or sorry, that was the previous example. As we think about what changes in rates would do to that prior example, let's consider a couple rules of thumb. Number one, a 1% interest rate translates to about a 10% change in the lump sum. For less than 1% moves, there's a linear correlation there. So if we were to take an April 2025 projected rate versus March 2025, discount rates looking like they're actually going to increase. And if that's the case, we're going to see the lump sum decrease. So when interest rates go up across the board, we typically see the lump sum decrease. And so you can see that here on the left. But again, those are rules of thumb. All right. This slide is designed to build on that 60-year-old retiree example. You may be wondering, why is the top bullet crossed out? Well, in the earlier example, we showed a simplified kind of scenario of how one might go about calculating the lump sum from the annuity. You can see that the shift higher in the assumed discount rates made the lump sum value, in this case, go lower. You can see that highlighted in green. But remember, it doesn't change the annuity payment. In each example, regardless of what the segment rates were, for someone retiring at 60, the annuity is still going to be about $71,000. So an often question that we get is when to consider delaying the pension. A quick note, remember, delaying is only available for the qualified portion. The non-qualified portion of the APP and SPP will have automatic payouts. But it's important to remember everyone's situation is different. And when you're thinking about delaying, and talk to your advisor about a couple different things. When do you think you need the money? If you're retiring prior to age 60, how would that potentially impact the financial plan? And also, what is the potential for interest rate changes in the future going to affect your financial plan and how to protect against some of those things? So it's a very important decision. And if you have questions or you're thinking about delaying, we're more than happy to discuss. So when thinking about the decisions that need to be made for retirement, Bogart's created a list of key events to be mindful of coming up. I'm actually going to go over this on the next slide, a little more detailed, so hang tight here. All right. So essentially, this is an example of a retirement roadmap for someone with a BCD of, call it March 1st, 25. Now, typically, you're going to want to inform your supervisor about 120 days, 90 to 120 days out. And this is going to include things like the last day on the payroll, first day of retirement, and the benefit commencement date. In addition, you're going to want to request the ITR package. ITR stands for Intent to Retire package. Now, after you receive the ITR package, you're going to want to review, complete it with notarization. And at this point, you'll review a lump sum / annuity election forms, the qualified rollover form, address verification form, and the non-qualified pension election form. And you must return this at least 35 days prior to the BCD. Now, don't forget, it's important to also change the medical plan method on the Exxon benefits website. So fast forward to within 1 or 2 days of the BCD, the lump sum rollover check will be delivered. The supplemental pension is paid via payroll. Next, you will hand deliver or send via prepaid UPS to Bogart Wealth. And then you're going to want to meet with your financial advisor at Bogart to talk about and finalize the plan for cash flow, investments, taxes, NUA, etc. 5 to 10 days after retirement, meet and complete the savings plan rollover call. 10 to 15 days after the rollover, the savings plan check will be received at Bogart. Savings plan IRA XOM shares will be received at Bogart, and then the NUA shares statement is received and emailed over to us. Now, there's a lot to this process. I know I went through it super fast, but we are happy to help with any questions or items that you'd like to consider along the way. So a couple things to consider now when planning for retirement. If you don't have a plan, make sure you get one. It can be helpful to develop a plan to alleviate any uncertainty as you transition to retirement. If you don't have a plan, Bogart Wealth would love to help you create one. And one of the most underrated planning items that I would say for retirement is having a budget. It might not be the most fun exercise. In fact, I don't think it's a fun exercise personally, but it's crucially important that you have a budget to monitor spending not only before retirement, but throughout retirement. And the budget really can help keep the financial plan on track. So any questions on that, please let your Bogart advisor know. So that concludes today's portion of the presentation about interest rates. If you don't have a financial plan, there's never a bad time to take the steps to get one. At Bogart, we're happy to meet with you, learn a little bit more about your situation and how we might be able to help. So when you're looking for a financial advisor, here's some things you might want to think about. Are they a certified financial planner? Are they familiar with your retirement plan and benefits? Are they able to speak in a way that you understand? Just some good, helpful tips to consider when you're evaluating different financial advisors. So that being said, if you're interested in a one-on-one financial strategy session with us, please feel free to contact us with questions. And with that, I want to thank you for joining today's webinar. For the latest content, upcoming webinars and more, Facebook, LinkedIn, Instagram, YouTube, feel free to give us a follow. We have a ton of educational content there. And with that, I want to thank you for joining today's webinar, and we will talk to you soon.